Let me ask you this question. Would you rather have this $1 million today or this magic penny? How this magic penny works is that it can double its value every single day for 31 days straight. On the very first day is 1 penny. But on the second day, it found a friend and it became 2 pennies. On the third day, it multiplied by 2, we got 4 pennies and so forth. So which one would you rather have? The $1 million straight up today or this magic penny? Of course, when someone poses a question like this, you already know that this magic penny will win. But by how much? I'm going to throw out 4 options here. A, 2 million. B, 5 million. C, 10 million. Or D, 20 million. What do you think the answer is? Back in the school days, I had a strategy that when in doubt, choose C. There's nothing scientific behind it. But what do you think the answer is? Am I using reverse psychology that's luring you to choose C, where the answer is only A, 2 million? Or am I using the reverse of the reverse psychology, where the answer is C, and already given the answer to you on the plate? Well, let's take a look now, shall we? As we can see here, day 1 is at 1 cent, day 11 is at $10.24, day 21 is at $10,000. But this is where the magic happens. From day 21 to day 31, it went from $10,000 all the way to $10 million. So you're right, the answer is C, 10 million. Instead of having this $1 million today, you could have had 10 million in a month. But who would have known, right? Welcome back, mindful investors. I'm just here to share some ideas that may make or save you some money. In our magic penny experiment, we demonstrated 2 points. Point number 1, as Albert Einstein says, compound interest is the 8th wonder of the world. And point number 2, don't rush into flashy things like the $1 million without doing your own due diligence. And that goes for the stock picks that YouTubers are pushing you or the courses they're trying to sell you for $10,000, claiming they have strategies to beat the market. If it sounds too good to be true, it probably is. Now we'll pull out the equation to calculate compound interest. We have A equals P multiplied by 1 plus R over N to the power of N times T. I'm not going to go through all these variables here, but there's one point I want to make. This N value is very important. This N value represents the number of times interest is applied per time period, which means whenever you see an interest rate, say 5%, is it calculated per year, semi-annually, per month, per week, or per day? That makes a huge difference. I'm going to show you the effect of different compounding periods. As we move from annual to semi-annually to quarterly to monthly, the amount increases. And that's because of the power of compounding. If we only had a 1 year time frame, we only compound once. Semi-annually, we can do it twice. Quarterly, 4 times. Monthly, 12 times. So if you compound it 12 times, it's going to be definitely a lot more than if you just compound it once. As we see in this example, annually, it went from 1,000 to 2,100. But if we move to the monthly, it went to 2,204. So it went from 2,100 to 2,204 in year 2. That's a difference of $104 just by changing this N value. If you've seen some of my other videos, you probably know that I love analogies. Now I'm going to demonstrate the compound effect. So a couple weeks ago, I picked up these juggling balls. On the very first day, there's nothing for me to do but just throw this ball up and down. And on day number 2, I might be switching hands. And this is like to gauge the weight of the ball, how hard to throw, where to position the hand and such. And then once you get the hang of things, you will try 2, throwing 2 at the same time. And after that, you'll pick up 1 more and you'll try 3. So what the heck was that about? How does juggling relate to investing to compound interest? It doesn't make any sense. Just give me a minute to explain. This is the fundamentals of the compound effect. When we want to learn something new, we always start at 0. Whether if it's juggling or investing. And once you put some effort into it, you're on day 1, where I was juggling 1 ball. As for investing, you could be investing your first $100. With all the commission-free brokerages and fractional shares, that make things much easier. And with your first $100, you may be buying index funds or your favorite blue chippers. But as time goes on, where you're comfortable from moving to one ball to two, you may be getting into the growth tech stocks or the penny stocks even. This all happens when you start compounding your skill, money, or confidence or whatever. Everything takes time. And then once you're comfortable with that second level, you can move on to the third level, where you juggle all three. As for investing, there might be time when you speculate with options or whatever. So this compounding effect works for everything. I'm going to show you how consistent efforts can lead to substantial gains in the long term. For instance, if we're improving ourselves 1% per day, let's say we have a power level of 100 on day 0. On day 1, we gain 1% to 101. Without compounding, we're gaining 1% per day, which is 100 on day 0, 101 on day 1, 102 on day 2, and so forth. So in the calculator here, we put in 1.01 to the power of 365, and we get an answer of 37.78, which means with consistent efforts to get better, we can lead to the substantial gains. And then if we look at the opposite end of the spectrum, where we lose 1% of our skill every day for 365 days, 0.99 to the power of 365, that equals 0.0255, which means you're only left with 3% of your skill if you continuously diminish your skill for a whole year. So do you kind of see how powerful this compound interest is? Without compounding, we're just adding 365 to that 100, which makes us 465. But with compounding, we have 3,880. Look at that difference. There's your 10x returns. If we're making efforts to compound whatever we're doing, either investing, acquiring a skill, building a relationship, whatever. If you continuously work on something, you'll get magnificent returns. I believe it was Bill Gates who said this. People always overestimate what they can get in the short term, but widely underestimate what they can do in the long term. For example, we're going to take a look at the analytics of my YouTube channel here. So this year, we see these spikes in January and March, where I consistently uploaded maybe twice a week. But then everything dropped off for about 6 months. Then it starts to pick back up once I start to put consistent efforts into it. We see this gradual increase in watch time, subscriber, everything, and that shows growth. While investing, we also like to see this consistent growth, where the trend is upwards. It doesn't matter through the spikes and all the volatility we call it. As long as we know that the end point would be much higher than the starting point, then everything would be worthwhile. Either building your skill or investing is all the same. Whatever it is in life, you start off with 1 ball, you juggle 6. You start off with $100, you will end at $1 million. But there's a huge caveat here, and we have to start somewhere. No matter what it is, we always start at the bottom, and we slowly build ourselves up to where you want to get to. And this takes continual efforts over time. Just like our magic penny, our juggling, or building a portfolio. Everything. Instead of using this equation with a whole bunch of variables, I'm going to show you this quick way to calculate how long it'll take for you to double your money. And this is called the rule of 72. It's really simple. Let's say if you have an investment that gives you 4% compounded annually. So how long will it take for your $1,000 to double to $2,000? Without the power of compound interest, we get 4% per year, which means it will take 25 years to double the money. 25 times 4% is 100%. So 25 years. But with compounding and the rule of 72, we have 4 going into 72 18 times. And how do you calculate that? 72 divided by 4 is 18, which means it takes around 18 years for you to double your money. And if the investment compounded at 12%, how many years would it take to double? 72 divided by 12 is 6 years. Simple. This is only an approximation. It can be off by a half year or 1.5 years, but we didn't need a calculator to do any of this. So do you see how powerful compounding interest is? How consistent efforts can lead to substantial gains? Let me know how you'll apply this concept. Again, thanks for watching. Remember to hit the like and subscribe button if you found any value. Take care, and I'll see you in the next one.